Welcome to Founder Tactics, a podcast about entrepreneurs and the communities that shape them. I'm your host, Julia Lucidi, and today we'll be tuning in to a panel discussion recorded at the Fort Lauderdale Tech Meetup. We launched the Meetup in 2023 to serve the growing tech community in Fort Lauderdale and further regions like West Palm Beach. We get together once a month to network and learn from industry experts through panel discussions. So if you're ever in town, definitely join us. Just visit ftltechmeetup.com to get all the details. There has been a ton of buzz about Miami being a tech hub. Is it the next Silicon Valley? And perhaps what hasn't been discussed enough is the unique fabric of small businesses and startups that don't technically fit that venture capital model. So in this panel, we invited Edin Capital to lead us in a conversation around what it could look like to build sustainable growth for South Florida, keeping in mind the diversity of companies that we have here that make Florida such a powerful place to do business. If venture capital is only part of the solution, what are the alternatives? On this episode, we'll be discussing an alternative instrument designed to address financial opportunities in the early stage market. This innovative approach not only provides a novel funding solution for founders and investors, but it also highlights the untapped financial opportunity in support of a broader range of early stage companies, a key driver of sustainable economic growth in South Florida. Joining us are the three partners at Edin Capital: Andrew Davis, a serial founder, Fortune 30 operator, and global investor; Aurelia Edwards, a serial founder and community builder working to bridge early stage funding gaps; and Erick Gavin, an ecosystem builder, operator, and advisor focused on the development of emerging ecosystems, who also previously served as executive director of Venture Miami. Before we get started, don't forget to subscribe or follow the podcast on whichever platform you're listening to us now. It's the best way for you to stay notified of future episodes that we release, and it also helps our channel grow. Thank you so much for being a part of our listener community, and we hope you enjoy this episode. Let's get started and begin with some introductions. So we will start first with Aurelia. If you can, I pronounce your name very Brazilian. Is that okay?
That's completely okay.
Okay. We can start with Aurelia. Tell us who you are, what do you do, and why is this topic so important to you?
Well, good evening, everyone. Thank you for spending your Tuesday evening with us. I'm Aurelia Edwards. I am a general partner at Edin Capital, and I'm really excited to present this to everyone here tonight. I'm a three-time founder. I'm currently running a startup called Standard Measure Technologies, and I had to leave South Florida to get my first investor check. And that was a question that I didn't understand why. They wanted me to relocate to Nevada. That's where I ended up going, to Reno. I didn't know much about Reno other than Reno 911. So I'm like, what am I getting myself into? So the first night I stayed at the casino, Circus wasn't very glamorous. So I'm like, what am I getting myself into? But they also call it the Florida of the West. Didn't know that. But I had an amazing experience. I was there for 10 months. I set up a second headquarters there. And I was able to network through Reno, which is the local ecosystem, Carson City, which is their state capital and a lot of their state incentives, and then Las Vegas, which is where a lot of the federal offices are. And I did that in 10 months. And I realized that the risk profile of the investors on the West Coast felt very different than here in South Florida. My family is here. I went to school here. This is home. So naturally, Florida is still going to be my home. So I go back every 3 months. But when I came back, I was speaking on a panel just like this, and I was talking about how different it felt. The risk profile, I feel like the investors here might be a little more conservative. I struggled because I have some revenue. So investors would tell me you need more. And I'm like, I just don't understand where I fit in this investment model. And during this panel, Andrew was in the audience. And afterwards, it was like, I really connect with what you're saying. I live here in Broward. I'm in Davie. My office is at the Levan Center. I'm going to plug the Levan Center. It's an amazing center of innovation. But I found myself driving to Miami all the time. Andrew's from West Palm Beach. Erick is from Miami. And I wanted to know, why, when you hear about South Florida, a lot of the opportunities are in Miami, and a lot of them are landlocked in Miami. Like, you have to have either your residence or your business registered there. how can we bring like connective tissue amongst the three counties? In my previous life, I was a massage therapist, had a lot of wealthy clients. They have family offices. They're all based in West Palm Beach, but I don't always see them investing into the South Florida ecosystem. And what I saw was a slight lack of maybe education for investors to see what the deal flow actually looks like, because I'm seeing a lot of early stage founders here in South Florida leaving and going to Tulsa. They're going to Wisconsin. They're going to other ecosystems to get their first check. Or you're seeing investors outside of this market investing at the early stage, right? Like pre-seed, seed, investing into these markets. So that it just left a big question. And we started kind of just banging our heads together every week for the last 10 months ish. 8, 10 months. And finally, we're like, okay, we think we have something that we can propose to the community, right? As a founder, a lot of people want to support me. I'm a Black woman in tech, so you don't see a lot of us. So a lot of people want to support me. They don't know how. So talking to banks, talking to economic opportunities between Broward County, Miami, and Palm Beach, and like, well, what can we do? And the one thing that I saw was we don't really work well together. Why when we have an event, everyone's having the event on the same night. We're sharing the same audience. Like that's just an easy way that we can change how we kind of work together as an ecosystem. So I think there's a lot of beautiful work that's being done currently, but there's still a lot more that can be done to support our early stage founders to see the system, the ecosystem be more sustainable so that we can have better pay, more affordable housing, like all the things that we need to have a successful business. You still need to have a successful entrepreneur at the heart of it.
That's so hard to follow. It was so eloquent. Wow. Hello, everyone. My name is Erick Gavin. I am also a general partner at Edin Capital. Where should I start? So I've been doing ecosystem work for almost a decade now. In Miami, I'm in Miami-Dade, and a lot of what I want to echo about what Aurelia was kind of speaking to is that people in Miami do have this kind of double-edged sword where they think that a lot of things only happen in Miami for the sake of having in Miami, and that anything outside of Miami is not important, right? Which I'm here to have that conversation today. It's a rough one, but we should get through it. Predominantly, what we should look to first is if we could look at data and information to say if Miami is considered as a tech ecosystem, it's not actually just Miami. It's all of South Florida. And when that data is normally compiled, it is percentage based off of, yes, there's a hyper concentration in Miami-Dade, but we do not get anywhere close to the numbers of other metro areas if we discount Broward and West Palm. So we have to consistently think about how we bring up South Florida more broadly, because that's where our kind of value lies at the end of the day. I came to Miami 10 years ago at the University of Miami. I went to law school there. And about halfway through law school, I started to just peek a little bit into tech because I was doing contracts for startups through the practicum that was there. It's a thing called the Law Startup Practicum. It's the best thing ever. They would send startups, like really young startups, to us, and we didn't know what we were doing, but we were reading contracts and like figuring stuff out. I got an A in contracts, so people were like, "You must know something about contracts. You should be good with it." But we did that and learned IP, and that was kind of my peek in. But I started to get annoyed because lawyers play the sidelines. We help people do great stuff. We weren't always the person that was innovating or the person that was pushing things forward. So then I got the crazy idea to go to a boot camp. So I ended up, once I graduated, I went to a tech company, and I did product design and product management for about a year. And then once I got out of that, I was about to go into another tech company doing data analysis and product management again. But I ended up going to a not-for-profit called the Center for Black Innovation, where I started an accelerator and did this larger data analysis project about how do we build accessible ecosystems. It was through that I started to get really deeper into ecosystem work and how do we think about ecosystems in a more complex way. One big thing that I took away from that project was we do all this comparison. So we started the conversation earlier about like, hey, how does Miami compare to, and then you start listing off all the major tech hubs like SF, and then you look at Boston, and you look at Austin, and you look at all these respective places. But it kind of discounts the fact that all of these cities are in different life cycles economically in terms of where they're at. And not only that, in terms of what industries that they focus in, where their certain sectors are at, It's not to say that we shouldn't do any comparison whatsoever, but it is to say that sometimes it's kind of like comparing apples to oranges. You can't really do that every time to evaluate what the value of an ecosystem actually is. So how do we evaluate the ecosystem in South Florida more broadly when we're trying to think about what makes sense for it? Well, how does it grow? And my big word for this year is mature. How mature is South Florida's ecosystem? How do we build infrastructure that shows that we can hold and host companies that are actually ready to either receive investment, be stable companies that continue growth even if they're bootstrapping, or grow companies if they have very nascent ideas to give them the resources that they need respectively? So big light bulb moment for me. And I was about to go back into a tech company and kind of sideline that, but I ended up getting appointed through a lot longer of a story. And I will tell it another time, but at the city of Miami, to be executive director for Venture Miami. I did that for the past 3 years. I just left in November. And primarily what I did there was think about how we leverage technology innovation for economic development. So how do we work with all the EDOs? How do we work with economic development organizations? How do we work with corporate companies? How do we work with smaller startups? How do we work with small businesses and resources around them to develop what would be a more burgeoning economy for these nascent industries that exist? So right now, if you look at workforce, very, very small percentage of our workforce, at least in the metro area, as it's thought, actually works in technology. Most of it's still in hospitality, and most of it's still in other more traditional industries. So if we're talking about this boom in tech, it's like how much of that boom is actually impacting the local economy. And so we need to start evaluating some of these things when we're having conversations with our cities, our counties, and what the outsized impact of those are going to be. And if we do all believe, and I know everybody has at least read one AI story in the last 20 minutes and has heard about like what things are going to changes are going to happen with that, how do we actually start to show how those are going to impact industries that we have developed or are consistent here in not only this Miami, but in South Florida more broadly? So after doing that work for about 3 years, I wanted to take some of the things that I had learned from that and start new programs, initiatives, and engagements. And one of them was Edin Capital, because Aurelia tapped me and she said, "Hey, Erick, I have this problem." And then we went on this whole, I think it was like 2-hour rant. It was a very long rant. And it was on the phone, so nobody, it was just us. And we were like, this is wrong and this is wrong. We need to fix this and we need to do this. And then she's like, I'm going to bring in my buddy. And then Andrew got on the call and it's like, I'm going to rant about this too. So after they say 8 to 10 months, but it feels like 8 to 10 months, but it felt like kind of 2 or 3 years, because we spent an enormous amount of time talking about all these issues. How do you better connect the South Florida region? What pockets exist that we need to fix for? The region only comes together when you talk about big projects. Actually, quick show of hands. How many people know that at one point in time, South Florida was up for Amazon HQ2? Do you guys remember that? Remember how, like, if you were like a part of that at all, or had heard about that at all, it was this big, huge, and for people that don't know, it's this big, huge project where Amazon was trying to determine where their headquarters was going to be for the second branch. Obviously, it's not here because you would have known about it by now. It's in Arlington. It's up in DC, basically. The reason why that's so important is because at that time, the entire region came together to figure out, like, how can we do this? Like, how can we convince them to do this thing? And that's the problem. We only ever like have these big watershed moments coming together when there's a huge project that's involved in it respectively. We don't have any connective tissue for normal conversations, normal engagements, kind of not smaller, but more important infrastructure things that should happen, so that when another opportunity like that comes along, we're ready for it. We're very reactive. And so how do we start thinking about the region as being less reactive or more proactive? I'll stop there because I feel like I'm rambling and leave it there.
No, that's great. And yeah, feel very aligned in our mission to want to create more connectivity amongst these 3 counties that are such a bulk of the economy for South Florida, and yet very poorly optimized. But we're changing that. You know, this meetup has been a testament to that, honestly.
Piece by piece, yes.
So it's really been in my heart to be able to build something like this too. So it's really encouraging to hear that from you guys. Yeah, Andrew.
Hey, folks. Andrew Davis. I am a Philly and Jersey boy. Born in Philly, raised in Jersey, always back and forth. School at Rutgers, in and out of New York. And there are a lot of us down here, surprisingly and increasingly. I joined the migration down here about 4 years ago. My wife and I came down. We did Miami for a bit. We're here in Fort Lauderdale, now in West Palm area. My background is a bit all over the place in the innovation ecosystem, very unintentionally. Founded a few companies, worked in corporate innovation at Google and Comcast, spinning up new businesses and organizations. Worked with startups across virtually every stage, from the earliest to the very latest, as an investor, an early employee, an advisor. And on the investment side, invested on every continent, largely through Techstars. Spent some time in Boston, in Austin, in London, and ventures very near venture capital and startups and innovation, very near and dear to my heart. And did a stint in film and TV finance and worked with family offices. And I heart for innovation and startups and building and investing. And this particular journey that we're now on started for me, I guess, 4 or 5 years ago. If anyone knows Philly at all, well, big homelessness problem, and always hit my heart. And, you try to give money here and there, $10, $20, maybe send up a prayer. But beyond that, there's not too much you can do. That always frustrated me very, very deeply, and began thinking, how do you create better infrastructure to help marginalized and disenfranchised folks like this? The whole mantra, you give a man, a fish, you feed him for a day, teach him how to fish, you feed him for life. That was sort of the driving thought behind it all. And that was one side on the social impact. And I'd been primarily, and from a business standpoint, on the capitalist side, building things, creating things, driving value. And I saw very clearly two sides of potentially the same coin. And it was the early innings of it. The social impact side, providing, foundational needs for what a lot of nonprofits do through the ecosystem. And what capitalism does so well in, creating value and growth and sustainability, they had things that the other didn't, and they solved gaps and problems, but there was no real connective tissue. So I started thinking, how would you create a system, and a socioeconomic system and structure to take everyone along for the journey, such that when you create such economic vibrancy, people don't get left behind. And if you do that properly, you could set a new standard for economic development. And running in the background to this, I was learning a lot about biomimicry, which is a kind of an emerging discipline. Anyone heard of biomimicry before? One hand. All right. Cool. And at a high level, it's nature-inspired innovation. And you see it a lot in hardware or material science, architectural design, even software. A lot of the stuff that we're seeing right now in AI was fundamentally created based on thinking about and getting inspiration from our neural networks in our brain. So it's a discipline that we've seen a lot of value from, and largely technological. And my whole thought process, well, if it works over here, could it be applied socioeconomically? And whether you come from a worldview that is, Christian, or believing in God, or more evolutionary, and I come from a Christian background. I believe in a good, loving designer. Regardless of where your disposition is, as you look out here, what you see is elegance. What you see are structures that work and are scalable and efficient. And for me, it's like, okay, you get all this stuff out here. We've seen some examples in technology. What would this look like from a socioeconomic standpoint? And it validated what I started seeing and what I was working on from this social impact and economic side of things. And it was the birth of Edin Capital long before we called it Edin Capital. And as I was talking with Aurelia and Erick about how we might do things different here in South Florida, but between West Palm to Miami, it's roughly the same distance as between the Bay Area and Silicon Valley. And the thought was, well, could we stitch together this ecosystem in an intentional way, layered on top of this potentially new socioeconomic model? And we just started jamming on so much stuff. And my brain is largely from an investor standpoint, but also this kind of economic development and social impact world. And being from the 3 counties, being from different backgrounds, we just started jamming on so much. And we landed on setting up a fund with a thesis. We're calling it integrated capital, potentially a new asset class. But we'll see where we go with it. And the whole thesis is what happens when you embed investing capabilities inside of an existing organization or an ecosystem. to create net new value. And so from an ecosystem standpoint, we're setting some stuff up down here in South Florida, and it's the kind of topic for tonight.
No, that's excellent. So as you guys can see, venture capital is part of the solution it adds value to economic development, but there's a big portion that's not been fully integrated and thought through when it comes to developing tech in business communities. And that's really the gap that we're looking to discuss here. Andrew, I think it would be helpful to dive into how does the venture capital model work and where has it left some gaps that this new instrument would be coming in to address?
Yeah, sure. So venture capital is a very specific thing for very specific investors for very specific companies. Venture capital acts as rocket fuel for rocket ships, meaning the companies that VCs look to invest in, there are massive outcomes that you have to underwrite to in order for the fundamental math to work. What that means more specifically, and maybe with an example, say you have a $100 million fund, and let's assume that an investor cuts a check and they can get 10% of a company. Oftentimes it's less than that. And over time, as the company continues to grow and take on additional capital, that percentage will dilute. But let's assume you stay at 10%. The company goes off to exit for $1 billion. With that 10%, the investor would get $100 million back. You would think that's an amazing outcome. And it is for the founders and to a degree for the investors. The problem is that for VCs, the funds get underwritten to 3 to 5x multiple, meaning a VC has to return 3 to 5 times their money. So with a $100 million fund, the expectation is that you get $300 to $500 million back. And with each investment, VCs are risky games, startups are a risky game. You anticipate most companies failing because it's hard and it's just the nature of startups. So with one investment, you get $100 million back, and say no other companies exit, you have not gotten your 3 to 5x, which means as a VC, in many ways, you have failed. You have not returned the kind of money back to your investors, because VCs are money managers. They get their money from pension funds and sovereign wealth funds and a whole bunch of other places. And there's the expectation for that type of return profile, which means you have to get massive, massive exits. So anyone here how many founders in a room? How many folks have gone to VC? Gotten rejected by VC, not large enough market, not enough growth, all the things. Some of it's valid, some of it's not. But the big takeaway is they're looking for a very specific type of thing. So if you have a company that can hit 30 million, 40 million, 50 million in revenue, that's a beautiful company. Beautiful company. Most VCs won't touch it because it doesn't have the kind of growth trajectory. What that means is that there's a massive opportunity to back companies that aren't being addressed by venture capital. 35 some odd million small businesses in the US, and a small business defined pretty broadly. I think, was it sub 500 people or 100 people?
Yeah, that's about it.
Most companies fit that description. Last year, VCs funded 15,000 companies. 15,000 out of 35 million. What happens to all the other companies? As it stands today, there is no other institutionalized, early stage, risk-based financing for companies that are not going the boom or bust route, meaning taking in venture dollars to try to build a rocket ship. But these are great businesses. And there's a big opportunity to address there. So that's part of what we see from an opportunity standpoint. And this isn't to bash VC. Awesome asset class. It is something that will stay around and has produced so much value, will continue to. But there's a lot left on the table, and a lot of founders that need access to capital because your options are pretty limited. You either kind of contort yourself to be a venture backable company if you're not meant to. You try to wrangle together angel investors or go to angel networks, and hopefully you can find them. If you do, they're probably not deploying as much capital as you would anticipate or want. So VC, angels, you're taking on debt, either personally or through the business if you can get it. You're going through the SBA, or you're bootstrapping. And so there's an equity financing gap in there that we want to fill because there's a big opportunity there.
No, that's great. Aurelia, perhaps you could give us a little bit of like the founder perspective of a bit of that difficulty of aligning goals and values with the traditional venture capital model, and that journey of navigating and figuring out that path. Like why was there such a misalignment, and how could a different investment instrument better serve your values and your goals as a founder and as a business owner?
As a founder, there's no rule book that comes with investing. And I've had businesses before, but this was the first time I was looking for venture capital as a way to fund my business. If I try to align my goals with the VC's goals, the different ones, I'll be running in like a goose chase, because everybody has something different. They want more revenue. They want you to have a CTO or a different type of board. They're looking for certain traction, certain types of MRR. So what I noticed was like, okay, this doesn't make sense. I know I have a great company. Do I burn all of my capital now to show the traction and then possibly run out of cash and burn my company to the ground? Or do I keep my company alive by growing slow because I'm bootstrapping? But when I do that, I don't look like the profile that Andrew, I'm not a rocket ship. I'm like I can say I'm a Tesla maybe, or some other type of vehicle. It's fast enough.
Ah, you're a plane for sure.
An airplane. So then you look to your other options, right? So I'm looking to possibly angels, family offices. What other options do I have that may have a little bit more leniency on investing on an early stage founder? And going back to the differences that I saw between being in Nevada on the West Coast versus being out here in South Florida. On the West Coast, a lot of the angels there had exited companies and truly understood what it was like to be an investor. So they were willing to write 50K checks, 100K checks, and let it sit for 10 years and like see what happens. They were risky with their investments because they understood the market, understood the founders, knew what they were looking for. And then they had a little bit more, when you're talking about industry agnostic, they knew a little bit more about everything. They weren't kind of pigeonholed and like, I'm only investing in healthcare tech, or I'm only investing in this as an angel. And then when here in South Florida, especially with the clients that I had, they didn't want their money to be tied up for that long. So I felt like first they'll say, okay, well, we're early stage investors. We want you to have a valuation of $10 million. And I'm like, wow, that's a lot to me for an early stage. I'm thinking more, 5 million, 6 million as like a sweet spot for early stage. So I'm like, okay, well, I'm already not at the level here, what they're looking for. So I'm like, is that really early? Because on the West Coast, they're saying 3 million to 5 million is early. So I was just like disconnected. But what I realized is that the instruments that we're used to on the West Coast need to be shifted a little bit to make sense for the investors here on the East Coast. The family offices that I knew, they were still investing in other markets. They're investing in Chicago and Boston and New York because that's where they grew their wealth. That's where they had their communities and their networks, but not so much here. And so that was one of the gaps that I saw, is like, okay, well, how can I make this work for me using myself as the model? But I have so many founder friends who are in the same boat. Like, how can I make it work for them?
That's great. Erick, would you add anything or?
Well, just one note, because especially on the difference between asset classes and East Coast and West Coast, in particular here, what do most people think about in terms of an asset class that people invest in here? Real estate. Thank you. Yes, real estate. Very first thing. So the thing that you're being compared to normally is, should I put $1 million in Aurelia's company that's going to sit for like X period of time, and I'm not sure, or this other real estate deal that I've done like 10 times over that I've done consistently? That's the kind of like dichotomy that's being put forth every single time we're having these conversations. And it's not to say that that's the only way that investors think about it here, but it is to say that there is some, I don't want to say education, but there is some conversation that needs to be had around like how these assets are being thought about when we're talking about these private investments that could be made as opposed to what currently exists in the East Coast.
Would you like to add anything, Andrew?
Venture capital is a small industry. It's really loud and sexy, and you hear about it all the time. I think globally it sits at around 600 billion, which is a big number, but it's dwarfed in comparison to public equities, which I think is like some 30 trillion. Real estate that's at like 500. Like, venture capital is very, 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 very small. And when investors are cutting checks, these family offices or sovereign wealth funds or pension funds or insurance companies, and backing these venture managers, they're putting a little bit of money in, expecting really massive returns out of it. Hence the risk profile, and while these funds need to outperform. And the question is, if I can put my money in real estate, well, why would I put it in venture? It doesn't all click all the time for particularly more traditional investors. And so what we begin thinking about and talking about is how do you create a structure that enables you to still invest in early stage companies, that allows you to participate in the upside if these things, do go off to exit at one point. But if you have a solid, growing, profitable company, how do you create a structure where you can still get returns from that, as opposed to venture where you're putting in $1 million, $5 million, however much it is, and literally waiting 10 years with no liquidity, hoping for a big exit. It's a big bet. And we're hoping to create a structure that allows investors to look at early stage investing in a different way, that will also enable a larger pool of founders to get access to capital that they need to support their growth.
Excellent. I'd like to transition our conversation a little bit now more towards the solution. So this goes now deeper into Edin Capital. What is the new instrument that you're proposing, and how does it balance risk, liquidity, and an alignment for investors and founders?
We're playing around with a new name for this thing. I don't think I'll do it this time. We'll talk about the mechanics. It's a mix of an equity investment and profit sharing. So the equity component, meaning that you get shares in a company or maybe a convertible instrument to ultimately get shares. And in that way, investors can participate in the upside if there is an exit event, be it an acquisition or going to the public markets. And profit sharing, that enables companies to begin paying a percentage of their profits only when they've hit a certain threshold and have the means to actually provide those profits as a return back to investors. And again, the reason this is so fascinating and interesting is that it balances risk and liquidity and upside for both sides in a really powerful way. Because again, as an investor, you're putting money into things to get money out of it. That is why you invest. And there are a bunch of different asset classes that have different risk and reward profiles. But our assumption and our hypothesis here, and we've been dabbing on this for 10 months and having different conversations with investors throughout the ecosystem and different founders to be like, does this make sense? It makes sense to us. We've got different perspectives here. But we're starting to share it more to get more feedback. And again, the reason that it gets really interesting is that for most investors, you're looking to balance risk and reward, risk and upside. And this combination of equity and profit sharing does that in a way that we don't see on an institutional level, not even on a deal by deal level. It's starting to happen a little bit, but surely not through an institutional fund. And so we see it as a new approach to early stage investing.
So, anybody watch Shark Tank? Okay. So, we've been banging on this, and my parents watch Shark Tank, and I happen to be over and I'm walking by the TV, and Mr. Wonderful he's known for these royalty deals, right? And as I heard it, I'm like, oh, wow, this reminds me of exactly what we're talking about. He wants a little bit of equity, and of course he wants royalty in perpetuity, which everybody takes the deal. And I'm like, I don't think that's a great deal, but it works in like the CPG world. You hear it a lot, but you don't see it on this type of scale. When we think about the South Florida ecosystem, we want sustainability. I'm at the Levan Center. It's an amazing place for startups, but there are a lot of great small businesses that don't get the same opportunity and chances. We support them differently. What if we supported small businesses the same way we supported startups, right? So like the benefit of having this type of opportunity for investment, along with all the resources that our community partners give us from Miami, Broward County, and Palm Beach, we'll build better businesses. We'll create more jobs. And in the conversation that I've had with community partners, they get it because it's something that aligns with the initiatives that they want to see for the region. There's a lot of partners who have intentional interest in this region with a lot of money to deploy. But how do they get it into the hands of the companies that work? It's wonderful. We have all these great summits, and I'm a founder. I've been over mentored. I don't need to be mentored again. I just need the money and I need to know how to spend it. And I believe that having an instrument like this can get the hands into the companies, the startups, and the small businesses that fit the profile that aren't the right fit for venture, but are great businesses to help boost the ecosystem in South Florida.
And I kind of want you, I think the only thing I'll add is that I want you to notice the size that they're talking about when they're discussing this as a solution. So first and foremost, and I'm going to introduce this to you, Andrew, because I just think it made the most sense. The unlock for us in the conversation was about the liquidity issue that LPs were having. So as we were talking to different investors in completely different capacities, some just because we know them and other ones just because we were having different types of conversations, we asked them the question, like, what things were you guys running into that was a huge issue right now? And it was liquidity. It came back up constantly, time and time again. And one way that this is actively solving that is that you're not having the conversation about receiving funds, putting it into a blind pool, and then hoping that 7 to 10 years from now that it comes back in some terms of return. Returns start happening within 2 to 3 years, if not sooner than that, based on the structure that you give to that respective company. And so while the risk, and this is really important when Andrew is talking about, while the risk profile changes, you might be seeing like not necessarily 100x returns. If you lower the return profile just a little bit or a little bit more, the risk starts to not evaporate, not go away, because there is no zero risk type of investment, but it does dramatically and substantively fall. And you get to a point where liquidity starts to be the forefront thing that you put to those LPs that can receive returns back. And so on the other side, when we're talking about the companies, this starts to become a better conversation for them, where now, as Andrew was pointing out earlier, they don't necessarily have to try to contort themselves to make sure that they fit for VC if that's not the angle that they're going for. But then they also don't have to go to banks or other entities that may not see them as a good fit for debt. They still get an opportunity to have an equity investment to be able to move forward on it. So this is where this kind of came up with. And there are some institutions that have tried, like Andrew mentioned, this model like pieces and parts. But trying to do this at scale is a little bit of a new thing. And so we talked to enough partners where we're like, we think this is something that could be executed in that way.
If I can just add a bit more, like we see this aligning incentives in a way that you can't do without these mechanics. Without something that provides liquidity in this manner for investors, it means that they're pushing companies for these massive exits, even if that's not in the best interest of the company. It's about the returns. And yes, investors care about the people and companies that do well, but their key incentive, if I'm putting money into something, I'm hoping to get that money back in a return. And so in this manner, it aligns incentives, because as a early stage company that's growing, maybe a bit rapidly, maybe a bit slower, I can focus on building a good business and not have to worry about becoming this rocket ship decacorn and unicorn shiny thing, because that's the only option for my investors. This instrument allows both the investor and the founder to be on the same page for whatever the outcome is, even if it is that rocket ship at some point, or if the conversation is to stay private and go off into the sunset and pass the business down. You have different options now in a way that doesn't exist otherwise. And so from an instrument standpoint, an investing standpoint, we want to introduce that into the ecosystem while also combining this sort of social impact and economic development infrastructure with some of the other players in the ecosystem, whether it's at the government level, the municipalities and the counties, economic development agencies and organizations, startup and entrepreneurship support organizations, even large enterprise. There's a method and an operational connective tissue that we've been talking about, that when you stitch together this operational model and this investment model, we think it's the future of economic development holistically. And we think it could be the future of entrepreneurship, such that when you think about 5 years, 10 years down the line, we actually don't look like Silicon Valley. We look a little bit different. And in some ways, maybe even better, because we can bring the entire ecosystem along for the ride. What happens when you combine folks that are coming through the nonprofit sort of world and organizations now into these more capitalistic environments, and you create that flywheel rather than just focusing on companies that are shooting for billions in outcomes. Very different dynamic. And I think one that's a bit more sustainable and does better for society.
Imagine a world where we invest into a founder and they're based in West Palm Beach, but understanding there are opportunities with our community partners in Miami, in Miami-Dade, or in Broward County that can really get them to where they need to get to. That's something that I don't necessarily see here. So there are so many times I pitch and I get a lot of grants and people are always sending me things. And it's like, well, you have to be a resident or your business has to be located in 305. So much so they're like, well, why don't you just create another office in Miami? And I'm like, I don't want to, but having an overarching entity that crosses the 3 counties, we can then say we have a relationship already with this entity that by being a partner with Edin Capital, it unlocks their potential between the counties or amongst the counties. That's what success looks like for the founder. You're not stuck in one area. You're able to use all of the resources in South Florida because it's the South Florida ecosystem, which always right now tends to be just Miami, but it's really the South Florida ecosystem. So being able to unlock those doors for the founder. When I look at success for investors, one of the things, this was funny, about 3 weeks ago, I was at a summit and they had celebrity investors on the panel talking about their investment strategies. And one gentleman, he was a retired NFL player and had invested in a bunch of franchises and said that with his fund, he usually only follows on with investments if the top 20 investors are leading. So like an Andreessen Horowitz or Sequoia Capital, he'll follow on because they can't afford to take other players' money. They already have a risky job and tie it up on a bet that they're not sure about. So they'll follow on or they'll invest in franchise or things that are more safe. It tells you that there's an opportunity for investors who are looking for things that are de-risked that they can put their money into. His LPs, in a sense, or his seeders for his fund can't afford to have their money locked up for 10 years. These are young guys, right? They're going to come out, believe they need access to capital. Creating some type of investment where there's cash flow coming out of it, you can afford to leave your money now in for 10 years because you're able to get that money to do other things, invest in real estate, do other things with the capital you're getting out of it. So that's what we see success looking like for the investor. And of course, the price of eggs.
No, I'll just add one thing on the ecosystem. And the only thing that ecosystem players like at a baseline care about, at least in terms of counties and entrepreneurship or in all these respective things, are jobs. So everybody's like bottom line. We could talk about a lot of different things like economic growth and things. It's jobs. It's like how many jobs are you creating through X number of things? And then there's 2 big ways that you can create a bunch of jobs through all of these respective programs and things that we can happen. We can have one unicorn that ultimately comes out of South Florida and creates this huge wave of new jobs and then new entrepreneurs that spring from that. And that's kind of the bet recently. Everybody who is either in a firm or a fund has said to me at one point in time or another, Eric, we just need that one unicorn to come out of South Florida. And that's it. It's over. Like South Florida is going to blow up every single time. It's a very consistent thing that I hear. But there's another strategy that we can run in parallel to that. We should still do that and we should still shoot for that. But the other strategy we can run in parallel to that feels like this to me. It feels like, can we create a bunch of mid-sized companies that continue to expand the amount of people that they hire, the technologies that they bring on, and the types of companies that don't look like just a unicorn in parallel to that to either equal to that one unicorn that would be there or surpass that and go beyond that point. And that's kind of the bet. I feel like, at least on an ecosystem level, where we look at those companies, we invest in those types of companies, and those types of companies equal to or amount what would be the equivalent of an impact of a unicorn that would be at the end of the day, at least for South Florida specifically.
What are you 3 hoping that in this meetup you can gather from the community so that the community knows how they can also contribute? What could be your ask to the community in what you're building at Edin Capital?
I was joking with Julia earlier, and I said, hey, I could like bring people up to Fort Lauderdale Tech Meetup through a bus or through the train. I took the Bright Line today, and it got delayed, and I was super mad and got upset about it and everything. But I want to bridge the connectivity while these things get built out, like really baseline, like that doesn't seem like a big deal. It seems very flippant, but like really important to like see people face to face. Some of you guys will talk to me after. I have a lot of friends in the room right now that both live in Fort Lauderdale or made the trip up or made the trip down. And I think it's important for us to continue to do this repeatably over and over. So I want to figure out ways that we can consistently do this as groups as we move forward. And so as much as we can to bring more people from Miami up here to Fort Lauderdale to have conversation with you, I want to figure out how to do the same vice versa so that we can be more connective. So if my ask is, it's more creative ways to do that, because I think that that's a very simplistic and straightforward way. If there are more creative ways to do that, I would love to hear those.
I think specifically from founders, does this sound attractive? Knowing that there's a milestone, that once you hit a milestone, there's a trigger that you're going to have to start paying back towards the investment. Does that feel daunting? Does it feel like it'll work with your forecasting and how you plan out the next 5 years of growth for the company? Like, I'd like to hear like what that sounds like. Like, where do you think a comfortable, ARR would be? What type of profit margins do you think would feel like it's sustainable, where you can still operate and grow a business, but still pay back to your investors? So that's what I'd like to hear back, and having conversations in the weeks to follow to see what your thoughts are.
Yeah, very similar from my side. Feedback from founders: does this make sense to you? Does it resonate? If you were offered such a deal, would you take it? For the investors in the room, does this make sense? Would you deploy capital in this manner into early stage companies with a structure like this? And for any of the folks in the ecosystem across the board, again, government, nonprofit, enterprise, from an operational standpoint, do you see validity and value in operating in a truly interconnected ecosystem for South Florida across these 3 counties? Does it make sense? And would you get involved and plug in?
And that wraps up another episode of the Founder Tactics podcast. Thank you so much for joining us, and we look forward to having you join us again on future episodes. Don't forget to follow and subscribe to our channel so that you can get notified of all the latest interviews that we publish. See you next time.